We're Compound Everything, and we talk money markets and investing. And this week we are talking about Walter Schloss, and we are continuing on our conversation from last week. So if you didn't catch last week's, go back and watch that one, and then come back and watch this one.
This one might make more sense.
And this one might make more sense. We are talking about an investor that we have learned a lot of lessons from, because we love to learn from the greatest investors.
Yeah.
Just like when you learn anything, you learn from the best. So when we invest, we learn from the best.
Yes.
And he was one of the best.
So to recap, he was able to generate 15.3% compound annual returns over a period of 45 years from about 1955 to around the year 2000.
Which took $10,000
Which took $10,000 to about $16 million if you were able to do that.
So that is why we consider him
So
one of the
he's
best.
pretty good. He's described as one of the best to play the game.
Yeah.
He was a guy that liked hard numbers. He liked book value. He didn't like necessarily buying companies on earnings. He'd rather buy them not as he thought they or hoped they would be, but as they are right now. He bought on assets. Yeah. So he'd buy things that were trading at or, well, actually more so below asset values. So if he could find something trading below asset values, that was kind of in his wheelhouse. Yeah. And we went over kind of what he looked for as screeners before. He didn't like earnings plays very much in terms of being able to predict that in the future. Again, he was looking for companies as they were.
Yeah, working capital was definitely his metric.
Yeah, book value and working capital.
Working capital.
Yeah.
Yeah. So, and he didn't love management, and we talked about that again last week.
Yeah, didn't like to meet them.
So, what are other lessons that we have taken away from Walter Schloss?
So one big thing that stood out to me, and this is a perennial problem for I think almost every investor, and that is when to sell.
Oh, yes.
So oftentimes, I don't know about our viewers, but for me and you, we can look at a company and go, yeah, that looks cheap, right? And often we're right on that.
Yeah, we have a fairly good track record of buying the right companies. We have a not so great track record on selling when we should.
Right. And so that's the question is, when do you sell?
Yeah.
Right? So that's the perennial problem, I think, for most investors. And I've heard, I think Lilu said the same thing. He's like, it's difficult to know. And Walter Schloss said that exact same thing. He says, I don't have a formula for you as to when to buy, he had a formula almost when to buy. And he said, I don't have a checklist for you of when to sell. Per se. But he said a couple things that would serve as guideposts. One of the things he said in passing is he said, if I think I can make about, I can't remember if the number was 30 or 50, I'm pretty sure it was 50%. If I can make 50%, I'd be pretty happy with that.
And he did 15.3% annualized in 4.5 decades.
Yeah.
Saying that 50% was good, but everyone wants that like 500% return.
Right. Well, there's books written about 10 baggers.
Right. 100 baggers.
100 baggers.
By the way, that's a great book.
Yeah.
It is a good book.
Yeah. So everyone wants to find the multiple bagger, but he was happy just taking the small gains and then moving on to the next opportunity, whenever it arose. Yeah. And so his selling point was, I think, somewhat formulaic, but not really. His buy point seemed to be very, very formulaic. So here's an exact quote from Walter Schloss. He says, I have no formula for when to sell. You look to see where the company is, what it's doing, and what the downside is today. So that's what he thought. So what's the downside? What's the company doing? So there's a few kind of intangibles there. But it boiled down to probably 5 things. And that was the current price, the current downside, the current upside, the chance of success, and the estimated holding period.
None of those are like super concrete.
None of them are.
And that's what makes selling so difficult. Because what is the current downside?
Well, that's the question.
What is the probability?
Well, I guess for him, it would have been, well, how much has it risen above its book value, right? So if it had gone, the price had appreciated substantially above its book value, he would say, well, there's significant potential downside risk there. And he was a guy, as we mentioned in our last video, who was more interested in protecting his downside. That he said, I don't like to lose money. And so his big thing was protect the downside, don't lose money, and the upside will take care of itself.
It makes sense that one of the quotes that you said for him is, what is the downside today? And just talking about like watching his downside, and once he gets 50% or so over what he would consider to be fair value, because he was also a little bit of a mean reversion guy.
Yes.
And so he just believed that everything kind of returned back to its mean. Yeah. So it makes sense that 50% to him would have been kind of like overbought.
Yeah.
And it's going to go into the oversold territory.
Yeah.
Now, that being said, when we first started investing, we did actually sell when we thought companies were quite a bit above their intrinsic value. And we sold, and some of
those kept on running.
I was going to say, we've lost a lot of money just on mistakes of omission, I guess it would be, right? Not holding. I mean, we did make money, but we lost a lot of money and opportunity there because we did sell.
Yeah.
But the thing that we didn't do was relook at the story, because I think he says you have to reassess the company.
Yeah.
And we just went with kind of what we knew from before.
Yeah.
And we didn't reassess the story to realize, it's probably still at fair value. We can still run here.
We can still run there.
And those are painful. They're not losses, but those are painful misses when you held the company.
Now, Walter Schloss would say, sell and move on and don't worry about it.
Yeah,
well, he said something exactly like that to a group of lecture students.
I would like to ask him, did you not worry about it?
Well, I think he didn't, actually.
I don't know.
Well, maybe a little bit, but, I honestly...
Human.
We're all human, and he tried not to let emotion get in the way. And, one of the students asked him about how to keep emotion out of things.
It's hard.
And it's hard, right? Because we have to recognize that we are emotional creatures, and we do get, fear of missing out, and we get loss aversion, right? And I think the stronger pull for him was loss aversion. See, he hated losing money so much that he bought stocks that couldn't lose anymore. they were essentially, I mean, they could, and he actually recognized that they often would continue to go down, but he was covered by such a margin of safety that it shouldn't matter, right? And so that was his thing. And so the other reason I say he hated losing money so much is because he was profoundly diversified.
He was.
He would often hold somewhere in the realm of about 100 stocks.
Which is a lot.
And so he was diversified because he did not want to lose his investors' money.
Right.
And so he knew what he did worked, but he didn't want to have any one company be responsible for a large loss.
Now, one reason why he could hold so many positions is because he was a numbers guy.
Yes.
And, Buffett would say he doesn't like to be diversified. And he actually said that he tried to convince Walter not to be so diversified. But he said the thing that made Walter great was that you couldn't change his mind.
Yeah. And that's the thing. He got recognition in his paper. Warren Buffett wrote a paper about the super investors of Graham and Doddsville. And basically, I think he was combating some bad press that value investing got, and how it's a bunch of lucky monkeys who are picking numbers and whatnot. And, Walter Schloss was one of the super investors named by Warren Buffett in that article, saying value investing was working.
What year was that
in 1980 something.
And I think that's kind of what put Walter's name on the map.
Yeah.
Right?
There's not much bigger call out that you can get by other than being named by Warren Buffett. That's a pretty big.
True.
It's not a call out; it's a call up.
Right? Yeah, that's true. And going back to selling and whatnot, and Schloss being just so about that downside and being like, you just sell, move on. If it goes up another 100, 200%, you don't think about it. Warren Buffett did say something similar. He said, someone asked him and Charlie at a shareholders meeting, I think they said, how do you feel about when you sell a stock? Or maybe it was, I can't remember, maybe it was a stock that he sold, and then probably it was a position he sold, and they said, since you've sold it,
it went up 2 or 3 fold,
That's
whatever.
what I'm going to guess the question was. But their response, I remember, was, whenever we see a position increase quite a bit after we've sold it, we feel good about it because it means we're not playing the bigger fool's game.
That's brilliant. Yeah. I mean, because they didn't know it could have taken a significant downturn. All they know is what's happening now, and they can project somewhat into the future. But if that is uncertain, they cut their losses.
But that hindsight bias, it's
terrible thing.
It's terrible because you get caught up in that. You're like, oh, I shouldn't have done this. But you didn't know that at the time.
No. Well, I think of a recent example of that in a super investor who did just that, and it didn't work out so well for him, and that's Bill Ackman. So Bill Ackman owned and bought a large portion of a large block of Netflix stock. I think maybe a year and a half ago or something like that.
Maybe a little more than that. I don't know. Time goes so fast. But as of recent past.
Somewhat recent. We'll say recent past. But anyways, what ended up happening is, I think within 3 months, 6 months for sure, Netflix came out with a bad quarter, and their subscriber count dropped substantially. And I think almost literally within days, Bill Ackman liquidated the whole position.
Yeah.
Was out. He was out. That was
Yeah.
it. And unfortunately for Bill Ackman, if he had just held on a little longer, that stock, I think, went up
quite a bit
since then. And he lost a fair amount of money. I think he lost 25-30% on
Yeah, he did.
on that deal.
No, that's a little different because he lost.
Yes.
And sold. But we're talking about when you gain and you sell too early.
Yeah, no, and I totally agree. But I think the point being is that, super investors, they're not flawless.
No.
Right? They can't call the top.
No.
And neither could Walter Schloss.
No. Well, Charlie Munger in his most recent, Charlie Munger in one of the more recent interviews before his passing said that Baba was a bad position. He did not like his investment
Alibaba position. Yeah.
Yeah.
He said it was one of his biggest mistakes.
Yeah, which is kind of unfortunate because I think that might have been his last investment.
It was actually his last large investment, I think.
And he said it was one of his biggest mistakes.
So Walter Schloss, basically, we were just saying that he didn't think he could time the market.
Oh no, he was very against timing the market.
He was very against timing the market. And so, if anyone could, time the market, so to speak, then, obviously they'd be very successful. But Walter Schloss made no bones about not being able to call macro environments. He didn't trade on that.
No, and I have found that most super investors we find all say that. Terry Smith said there are two people who can time the market, right? Those who know they can't and those who think they can but can't.
Yeah, that's right.
Right, and then Warren Buffett says he doesn't worry about the macro, and Schloss says the same thing. I actually have a quote about market timing from Walter Schloss, and he says, I'm not good at market timing, so when people ask me what I think the market is doing, their guess is as good as mine.
Yeah.
And here's this amazing investor who compounded at an amazing percent for 4.5 decades, and he's saying, your guess
is as good as
my
guess.
as mine. And so he would say that to us or anyone, and let's be honest, he's a much more successful investor than we are.
Yeah.
Right?
And he might have some opinions on it, but he's acknowledging he might be right, he might be wrong.
Right. And I really think, I don't know how you could think you could predict the macro if you've lived the last 5 years.
Oh gosh, no.
Just everything that we've seen and all these central banks and with the interest rates going up and then, rumors of it going down and then not going down and then the money printing. It's just I don't know how you could come out and say anyone could predict that. The only people who can really predict the macro are probably the guys who are making all the policies.
Right. Yeah.
Right. And even then they don't.
And even then they don't always get it right.
They don't always get it right. Yeah. One point that Walter made that he really liked, and I was like, oh, that's very interesting because most of the guys I follow don't love these, and that was dividends.
Yeah.
And I know a lot of value investors don't love dividends because they feel that they have invested in good companies and they want to see that money allocated within the company for growth. They don't want it to be given to them, and there's tax implications too with that. But Walter Schloss loved dividends. He said that if a company paid a dividend, it showed that they were probably more in line with the shareholder.
Which is interesting. I don't think that's necessarily a wrong assessment.
Yeah, so I was like, okay, he's one of the first value guys I've actually heard really appreciate a dividend.
Well, because at every board meeting, you have to decide whether you're going to raise, lower, or keep the dividend the same. And so in doing so, you're thinking about the shareholders. Whenever that conversation comes up, the shareholders are in mind.
Right.
So it's not a bad policy, actually, interestingly
I'm not
enough.
a huge fan of dividends because I feel like it's kind of... it almost becomes a drug, and then if you do run into hard times, the management doesn't want to cut it, and
That's
they get
fair.
afraid to cut it because they know if they cut that dividend,
their share price will tank.
And so with a dividend, it has some negative implications there that make me a little nervous. But it was really cool to see him say that because everyone likes different things, and I really appreciated that he had a different viewpoint on dividends.
Yeah, which is interesting because, funny enough, so that's kind of almost like a fixed income kind of characteristic. But one of the things, someone asked him about bonds. So, Walter, what do you think about bonds? He's like, bonds are for old guys. He said, you won't make a lot of money off of bonds. He says, I much prefer stocks. Okay. Which is just an interesting aside.
Right,
So I just thought it would be a little tag on for... I like bonds, so maybe I'm old. I don't know.
Well, we're not young.
We're not young. That's not as young as we used to be anyways. So I just thought it was an interesting aside. The other thing that he said, a little pearl of wisdom, and I've kind of taken this to heart to a point as well. He said, you never know a stock as well as when you own it.
Oh, that's very true. And that's that's a Guy Spear mentality.
Yeah, and so one of the things that we've started doing in our own investing practice is taking small positions in stocks we're interested in. Mm-hmm. Because then you really once you've got your kind of foot in the door, you've got,
you're invested.
You're invested.
You're literally invested.
Yeah, you've got some skin in the game. Once you got some skin in the game, well, guess what? Then you start to look into things a little bit more. So, for instance, in our prior video, we mentioned that we've taken a little bit of a position in Diageo. Well, now you start looking around and saying, oh, well, where does Diageo sell? And
every restaurant we go to, we're looking at all the bottles.
We're looking at all the bottles, right?
Every time we talk to a server, we're like, what's the most common drink you sell?
Right. Well, then you start noticing competitors a lot more. So, there's Tito's vodka over there.
Yes, we were talking to someone about Bailey's, and they happened to not buy Irish cream.
Right.
And so we were like, oh, wait a minute, how does this taste?
But the point being is you start to see the warts of the company maybe a little better when you take a small position. And so it makes you look a little harder. So that's one of the practical things that we've done to maybe start to look into a company a little better. Mm-hmm. And don't hold it too tightly.
Yeah, don't fall in love. And
don't fall in love with it.
That is, and I don't know if that is my personality, and I really think it is, but I get an attachment to my companies. Mm-hmm. And I feel sad when I have to sell them. And here's what's interesting: the better they've done,
the harder it is to let go.
I feel because I get this like weird attachment, and it's so ridiculous because I know it's stupid.
Yeah.
But it's still a problem.
Yeah.
And I think it was Morgan Housel who said, like, we all have biases, and the only thing we can do is know we have them.
Yep.
And then do our best to not capitulate to them. But I feel that statement every time I have to sell a position.
Yeah, and that's one of the things he would say is don't fall in love with a position. Mm-hmm. He said look at it rationally. And so if you fall in love with a position, that becomes a problem. Mm-hmm. And so that's going back to kind of what we were talking about a little bit earlier. How do you kind of stay rational? That's one thing. Don't fall in love with a position. Yeah. Treat it rationally. And if it is overvalued or whatnot, then sell. He did tell a story about someone who, and this maybe isn't falling in love with the stock, but it's holding on to it maybe for the wrong reason. He held on to a stock that had appreciated substantially, all because he didn't want to take the tax hit.
Oh, no.
So he didn't sell it.
No, but I feel that, though, but oh, no.
So guess what happened? He never sold it. But then guess what happened?
It dropped.
It plummeted.
Oh, no.
So he would have been far better selling the stock and taking the tax hit than what actually happened.
That is so relatable.
Right. So the point being is, don't fall in love with a position, and taxes are just part of life. So going back and talking about when to sell, one of the things that Walter Schloss did is he'd exit a position over time. He'd sell in tranches. So he would.
I love that.
Yeah, he wouldn't sell all at once, because then, I mean, if it dips or drops from where you sold it, well, at least you took profits when it was higher. But if it continued to appreciate, at least you can kind of catch some of the upside.
Yeah, I never sell all at once, unless it's something like a merger
arb or whatever. Yeah,
one of the. But generally, in a position, I also tranche out. It has really. It lets me put my head down on the pillow and I can feel good about it.
Well, one of the things you said to me is, don't think you're so smart that you're going to catch the top. And it's true. Smart. No, but it's true though,
you're
right?
You're not as smart as the market.
No, exactly. And the market will, like...
The market loves to humiliate people.
I can't pick the bottom, and I recognize I can't pick the bottom. So a stock I buy might continue to go down after I've bought it. Likewise, a stock I sell, I can't pick the top. So a stock that I've bought might continue to appreciate after I've bought it, or after I've sold it, sorry. So oftentimes buying in tranches is just a way to mitigate that a little bit.
That's great advice from Walter Schloss.
Yeah.
Actually. Yeah.
So maybe this will be our last point. And I think this really well encapsulates Walter Schloss. He liked to buy troubled companies in troubled industries that were temporary. That's what he liked to look for. And he liked to look for companies that had temporary problems that he thought that people could fix.
An event
of sorts. And so he looked for companies that had problems that were workable. Mm-hmm. It wasn't like he was buying, a horseshoe manufacturer at the beginning of the automobile where it had structural issues.
Yeah, that's a big problem.
That's a big problem, right? But he'd be buying companies that were I wouldn't say in distress, but were having some temporary problems in industries that were having issues. Those were some of his favorite ones to look for.
There have been other investors I have heard who say the same thing.
Okay.
They say that they look for unloved sectors, and then they look for the most unloved company within that unloved sector.
Right.
And so it's a little different because some people like to look for the number one company in the sector. They like to look for the company leader.
Right.
That is probably more my style, but I have heard other great investors say that's what they do. They look for the most, and I guess that's the difference between a true value investor and more of a, I like to buy wonderful companies at fair prices investor.
Yeah. Well, and sometimes prices, and this is speaking a little bit about market efficiency, is that sometimes prices can significantly dislocate from value. And oftentimes it's in part because brokers and whatnot don't want to necessarily recommend a stock that's declined substantially to their customers. Like, it doesn't look really good to recommend a stock that's dropped 50% or something like that, and that's having some problems. You don't really, it's sticking your neck out there to recommend that to somebody. Whereas, a broker recommending, Nvidia, they've got great prospects. Oh, you should put some money into it, even though it's trading at a very high valuation. Potentially. Again, maybe it is, maybe it isn't.
I do think Nvidia is, now that I've said, like, ridiculous, I do actually think it's one of those ones that's probably going to continue to catch up to its valuation. Yeah.
But there's a chance that growth could slow down and whatnot, and so it's not sure.
Which is why Walter Schloss wouldn't look at, he said earnings.
He wouldn't look at earnings.
Earnings were a prediction, and predictions were not certain. So just, maybe we'll wrap it up almost there, but one fun fact about Walter Schloss is he somehow, in some convoluted way, part of the story of how it came about that everyone refers to Warren Buffett as Uncle Warren.
Yes.
And you hear people say, oh, Uncle Warren. And there's actually a story behind that. And like I said, Walter Schloss is kind of like in some convoluted way.
So there's a 60 some odd page article, an interview with Walter Schloss in something called the Outstanding Investors Digest.
Which you've read.
Which I read. And so in that, the author or the interviewer basically says that the term Uncle Warren came from one of their own subscribers. And so he would often refer to Warren Buffett as Uncle Warren because he would give stock tips.
Right, and people like that.
Similar to how Ben Graham would often give stock tips. And that was one of the things that Walter Schloss thought that maybe Ben Graham was a little too loose on, was giving stock tips. And Warren Buffett, I guess, followed in his footsteps, giving stock tips. And so this subscriber of Outstanding Investors Digest would refer to Warren as Uncle Warren because he was always giving stock tips.
And it made this
particular subscriber a lot of money.
Yeah.
Which is interesting.
And so people have been following super investors and great investors for a long time.
Yep.
And they've been becoming wealthy off doing so.
Yep.
And I don't think that it would make any sense for us to deviate from the path of also following super investors.
No, I think it's, cloning is, we started our talk about Walter Schloss with that idea, and I think we can end it there too, because I think it's a great idea.
Yeah. So that's everything this week. If you could like and subscribe our video, that really helps. And we will see you next week.